Over the course of the last 2 years, gold has jumped by 93%. It took gold almost 10 years to deliver these kind of results between 1997 to 2006, and almost 12 years from 2008 to 2019. This rally that we're seeing today is one of the strongest rallies in gold's history. But there is something very different about the rally that we're seeing today compared to the one in 2008. And we can see that in the gold production. Till 2008, the supply of gold was constantly decreasing, while the demand was increasing, pushing the prices up. But today, that is just not the case. Gold supply is ever increasing since 2008, yet prices are soaring sky high. Why? Today at CapitalCode, I will show you why these prices are soaring sky high. Can they continue to rise any higher despite these completely absurd returns that we have seen over the last couple of years, and how you can profit from this turning point in gold that has only surfaced 4 times in the past 3 decades. Gold making a 90% gain in less than 2 years has only been seen a couple of times throughout history. In 2011, in 2008, and in 2006, all of which were followed by a major crash of more than 25%. A 25% decline in gold today would take us back to approximately halfway down this rally. But these kind of large market corrections don't just happen for no reason. They require a specific set of environment for them to happen. Otherwise, the market can just keep going, like in November of 2010, when no catalysts appeared, and so gold continued to move all the way for almost another year. So, what's the difference between these instances in 2008 and in 2006 that saw a large market correction, and 2010, where gold did not correct all the way until 2011? And the most straightforward answer I can give you for that is overhedging. When economies, currencies, and banks are failing, and geopolitical tension is on the rise, hedge funds, financial institutions, and governments switch to other assets which aren't negatively affected by these factors, specifically the ultimate safe haven, which is gold. Let's look back at each of these instances to understand this better. 2006. Tensions were rising in the Middle East with the Lebanon war, prices of oil were rising, and the fear of the dollar weakening was on the rise. These 3 reasons caused every single institution to run to gold to hedge against these volatile markets, pushing gold prices up by 96%. Then the Feds increased rates, making debt more expensive and reducing the amount of dollars in circulation. Inflation reduced, the dollar gained value, and the stock market began to flourish. And gold sank by more than 25%. 2008. This one is very obvious. If you don't know, the answer is global financial crisis. And it is also the reason for the crash in 2011. Gold hit $1,032 in March 2008, and then the global financial crisis hit. Banks failed, and everyone was out of money. Their only option was to sell everything at hand, causing gold and oil, along with majority of the commodities market, to crash. Another thing to note is that the dollar was at its lowest point at the beginning of the crash, making it a lucrative investment at the time. At the same time, till 2008, gold production was steadily falling, whereas gold prices were increasing, which makes sense. But since then, we have a growing and flourishing gold production. Yet the prices of gold are rising. So why are gold prices increasing despite a growing supply? 2011. At the time, total market cap of gold was about $7.8 trillion. This was the biggest crash ever recorded in the history of gold, which wiped out more than $3 trillion from the market, all because of one mistake of the Feds, the quantitative easing policy. See, after the 2008 crash, in November of 2008, the Feds released QEP1, which basically meant they printed $1.7 trillion. They didn't know what to do. Banks were failing, everyone needed money, so they just printed it, devaluing the dollar to save the economy, only to delay the inevitable. All of the money they printed flew straight into assets, pushing their prices up and recovering the economy. And by 2010, gold made a 90% gain. It should have crashed, but we didn't see one for a whole another year until 2011. Why? Because the Feds had launched QEP2, releasing another $600 billion into the economy, devaluing the dollar more, and gold kept flying till 2011, until the bubble burst. Gold sank and lost almost half of its value. And we see all of these symptoms again today. The dollar is the lowest it has been in the past 3 years. The stock market has just started to recover, and all of the governments and financial institutions had been aggressively buying gold, in order to hedge themselves against the volatilities caused by the geopolitical tensions, caused by the Palestine war, the Russia-Ukraine war, the tariff war, and the India-Pakistan war tension. Today, we have all the same conditions set in place, which led every single gold crash. But there are two more things that determine if gold is going to crash. First, the CAGR, and second, is an indicator so powerful it has predicted every single gold crash in history: 2020, 2011, 2008, 2006. It literally has 100% accuracy. And today it has given the strongest signal ever, stronger than any of these past four crashes. First, the CAGR. It's the compounded annual growth rate, or the geometric mean return, which for gold stands at about 8%, meaning gold grows at about 8% every single year. But the problem is, for the past 2 years, the CAGR of gold is roughly 39%, which is almost 5 times its long-term CAGR. This rate of 39% is completely unsustainable. If it wasn't, then every government, every financial institution, and every individual would be throwing all their capital into gold. I mean, who wouldn't take the opportunity of doubling their money every 2 years? So to cool that number down, gold has to decline temporarily to get a more neutral position. And second, the RSI. The RSI has only crossed a level above 75 4 times in history before this, successfully predicting every single one of the gold crashes in almost 3 decades. It calculates its value on the basis of this equation. It reflects the overbought and the oversold conditions of the market. And today, it shows us the highest signal it ever has, at its value of 86.14, compared to 85.62, which was the highest before today, recorded in the 2008 rally, followed by a near 34% crash. A 34% crash today would rip $1,000 in value off of gold. If you want premium reports and insights on the financial markets like this, along with our live trade signals, head over to capitalcode.net. I'm looking forward to seeing you in the club.